Ladies and gentlemen, I just invite you to take your seats as we will begin very shortly. My name is Oliver Garrett-Jones from the OECD's Financial Markets Unit. I'll be your MC for the event this afternoon, so you'll hear from me at various points in the afternoon. And I'd like to start by offering you a very warm welcome to the inaugural OECD Roundtable on Global Financial Markets. Before we begin, I'd like to advise just really on 3 points of housekeeping. First, interpretation for the roundtable is available in English and French. Headsets for both languages are at the entrance of the room and to both sides as well. Channel 1 is in English and channel 2 is in French. Je répète en français, une interprétation en français et en anglais est disponible. Le casque audio se trouve à l'entrée et les deux côtés de la salle. Veuillez sélectionner canal 1 pour l'anglais et canal 2 pour le français. Second point, let me ask you to keep your phones on silent during the proceedings today, please. And also, thirdly, in case of emergency, please follow the instructions of the venue staff and exit via the marked doors, just like on an aeroplane. Let me also mention that this is a roundtable, which means that we'll have the opportunity for exchange with the discussants with one another as well when we move on to the discussion sessions a little later. Now, we don't have a table at the OECD big enough for 500 people to sit around, but the spirit of the roundtable is here. We will have roving microphones for questions and comments, and we do want to hear from you a little later on. Before those discussions, though, we will commence with opening remarks from the OECD Secretary General and a keynote from the Chairman of the US Securities and Exchanges Commission. And so, to open this roundtable, let us welcome Mathias Cormann, OECD Secretary General, to the stage.
Well, thank you very much, and a very warm welcome to you all, Chairman Atkins, distinguished guests, colleagues, friends all. A welcome to this first OECD Square Roundtable on Global Financial Markets. These roundtables, which we will host twice a year during the OECD's Financial Markets Week, provide a unique platform for dialogue among policymakers, regulators, and financial market participants. Your discussions here this afternoon will focus on ways to unlock stronger competitiveness and growth through sound, vibrant, and well-functioning capital markets. We are currently facing an uncertain economic outlook, high policy uncertainty, geopolitical and trade tensions, tighter financial conditions, weakening business, consumer, and investor confidence are all weighing on global investment and growth prospects. As we navigate these challenges and work together to restore policy certainty, we must also intensify efforts to revive the long-term growth prospects of our economies, which have been too weak over the past 2 decades. Potential GDP per capita growth for the OECD this year, that is, removing business cycle fluctuations, is estimated at 1.3%, down from around 2% in the 1990s. A key driver behind this trend has been the sharp decline in both public and private investment since the 2008 financial crisis, and that is despite the historically low borrowing costs and strong corporate profits during much of that period. We estimate that the contribution of investment to potential GDP per capita growth in the OECD has more than halved since the global financial crisis. Across advanced economies, total real investment volumes last year were 22% below the pre-global financial crisis trend level, and they were 7% below the pre-COVID trend level. Among businesses, investments in tangible assets such as infrastructure and machinery have even declined as a proportion of revenue since 2000. To improve our growth prospects and meet the rising fiscal pressures from population aging, financing requirements related to defense and infrastructure, enabling digital technology adoption, and to achieve our climate objectives, we need to find better ways to address long-standing structural weakness in investment. Implementing a range of ambitious reforms to unlock greater competition and business dynamism that incentivizes productive and productivity-enhancing investment. To encourage businesses to reinvest earnings where appropriate rather than focus on shareholder buyouts, and to deepen capital markets to provide more funding options for businesses and competition among lenders, particularly in Europe, by further developing the Savings and Investment Union. A new private investment will be especially critical as governments grapple with mounting fiscal pressures. Our global debt report this year projects central government marketable debt to reach 85% of GDP across the OECD, more than 10 percentage points higher than in 2019 and twice the level in 2007. Debt servicing costs have also increased as a share of GDP in about 2/3 of OECD countries in 2024, reaching 3.3% on average, up from 3% the year prior. And they're set to increase further this year and next. With central banks progressively withdrawing from debt markets, private investors will be needed to absorb a growing supply of government bonds. So vibrant, well-functioning capital markets have several key roles to play in meeting today's challenges, from supporting renewed business investment to providing sovereign debt market liquidity and sustainability. So your discussions today will cover three key areas where there is further untapped potential in capital markets and the policy frameworks needed to draw on it. First, further increasing the participation of certain key institutional investors, such as asset-backed pension funds and insurance companies, in equity markets, while protecting their beneficiaries and ensuring appropriate risk management. Asset-backed pensions more than tripled in value over the past 2 decades, from $15 trillion in 2001 to $56 trillion US in 2023. And insurance assets doubled from $12.9 trillion US in 2009 to $25.5 trillion US in 2023 in the 30 OECD countries with available data. As they have grown, they have increased their equity investments, providing valuable liquidity in public markets and much needed private capital for long-term projects, including infrastructure. In 2023, equities represented 27.1% of total investment of pension funds across the OECD, which was an 8.4 percentage point increase from 2008. This trend is positive news for investors. Our analysis across 38 OECD and non-OECD jurisdictions with defined contribution pension schemes shows that pension funds that invest in equity often generate better retirement outcomes. And there is room to grow further, unlocking more of the investment that our economies need while improving performance. However, greater reliance on equity investments can also increase the risk profile and volatility of investments, and regulations that safeguard the interests of beneficiaries in that context are essential, in particular to ensure sound management strategies that prevent equity market downturns close to an individual's retirement age from severely impacting their retirement income. To ensure the appropriate balance between risk and return in the case of pensions, for example, OECD work recommends that regulators allow providers to offer life cycle investment strategies which gradually reduce equity exposure as individuals near retirement, encouraging innovation in tailoring fund management to individual needs. Second, by enhancing the quality of sustainable finance products without imposing undue reporting burdens on businesses. Sustainable finance products continue to grow. For instance, at the end of 2023, corporate issuance of sustainable bonds reached $2.3 trillion US, while government issuance stood at $2 trillion. This represents a 6-fold increase over the period from 2019 to 2023, so just over a period of 4 years. As the market for these products has expanded, there has been a proliferation of taxonomies and reporting standards, making it more difficult for investors to assess the sustainability performance of issuers, and while imposing significant administrative burdens on issuers and ultimately discouraging the uptake of sustainable finance products. So your discussions today will explore how we can ensure market intermediaries have access to the necessary data to make informed investment decisions on sustainable products and mitigate greenwashing without substantially increasing the reporting burden on businesses and ensuring competition on a level playing field. Third, by encouraging the safe, secure and trustworthy use of AI in finance while safeguarding consumers and markets. Our latest estimates show that expected productivity gains from AI adoption in the finance sector are among the highest of all sectors, amounting to 12% of productivity growth in the sector across G7 economies over the next 10 years. AI technologies are already unlocking important efficiency gains in asset management and securities, including helping to optimize portfolio management, automating trading, and providing more accurate risk analysis. AI can also contribute to greater financial inclusion by broadening access to financial services for underserved or traditionally excluded populations. At the same time, the use of generative AI raises the risks of financial fraud and scams, as well as cyber attacks, among other concerns for consumers and businesses. The use of AI in financial markets can also increase market volatility if a significant number of participants rely on similar AI models, leading to a convergence of trading strategies and feedback loops between models. Your discussions today will explore supervisory approaches that balance the promotion of responsible AI in finance with policy objectives of market stability, integrity, and financial consumer protection. In closing, capital markets, as I know that you all fully appreciate, can make a powerful contribution to stronger growth, productivity, and opportunity in our economies, whether by investing in technology diffusion and innovation, infrastructure, business creation, or expansion. To make this happen, we need a sound policy environment that broadens participation and enables innovation in capital markets, all while ensuring consumers' interests and the stability of the financial system are protected. So these are very important conversations that you will be having here today. My very best wishes for a positive, constructive, and productive discussion, and it is now my great honor and privilege, without any further ado, to invite Mr. Atkins to take the podium to deliver his keynote remarks. Thank you.
Well, thank you very much, and good afternoon, ladies and gentlemen. First, I should like to thank you, Secretary General Cormann, for your warm introduction and warm welcome. Thanks also to Carmine for the invitation for me to participate in this inaugural roundtable, and for also having organized such a timely conversation on the ways in which we can work together to encourage global competition in the capital markets and to promote economic growth in our respective jurisdictions. I know that all of you are committed to these goals, as is demonstrated by your presence today with a full house to add to that. And it is my very special pleasure to be with you, especially as we at the Securities and Exchange Commission are returning to our core mandate of protecting investors, maintaining fair, orderly, and efficient markets, and in facilitating capital formation. Now, before I go further, I'm sure that you appreciate that the views that I express today here are my own and do not necessarily reflect those of the Securities and Exchange Commission as an institution or of my fellow commissioners. But for me, returning to France's homecoming of sorts, in the late 1980s, I was a young lawyer in the Paris office of a New York law firm, learning as much about the intricacies of international finance as the enduring value of cooperation across cultures. In the decades since, multiple tours of duty at the SEC have further underscored to me how the principles that we prize in the United States, among them the power of free enterprise and the vigor of capital markets, can find common cause abroad. And it's in that spirit that I welcome today's discussion on fueling growth and opportunity across our domestic economies. The topic of American and especially European collaboration is one that has fascinated me for many years. I remember well the run-up to the quote-unquote Big Bang of 1992 when I was here in Paris, which gave rise to the European single market and to the sweeping tides of opportunity that would follow. For those of us who were here at the time, it was invigorating to watch the European market take shape animated by the forces of commerce and competition, themes that are again in focus today as Europe considers the direction of the Savings and Investment Union, among other initiatives. At the same time, engagement outside of the new European market remained important, even for a continent knit more closely together. And of course, strong sovereign nations like the United States must continue to work constructively with the world in ways that promote our own prosperity. At the SEC, these priorities find expression in our work to attract foreign companies to the U.S. markets and to provide Americans with the opportunity to invest in those companies while ensuring that the U.S. and foreign firms experience a level playing field and that our investors are protected. Of course, the size and the depth of the U.S. capital markets have been and still are attractive to non-U.S. companies. They can achieve a variety of potential benefits, including higher valuation, greater liquidity, access to American capital, and enhanced publicity and reputation in the financial markets. So since the advent of the SEC back in 1934, our rules have granted special accommodations for foreign companies that access the U.S. markets. These accommodations recognize the differences in business and market practices, accounting standards, and corporate governance requirements, among other matters, between the U.S. and foreign companies. Still, the SEC has been mindful of the need for U.S. investors to be equipped with adequate knowledge about the foreign issuers and to the extent to which such information was provided under the laws of their home country jurisdictions. In 1983, the SEC developed the foundations of its current standards for which foreign companies qualify for these special accommodations. Since then, the SEC has reassessed and updated its standard as needed to address changes in the global markets and to protect U.S. investors. In one of my first actions as chairman, I asked the Commission to approve the issuance of a concept release to gather public feedback on whether the standard should be updated to reflect the evolution in financial markets and corporate legal structures. This concept release seeks public feedback on whether foreign companies listed in the United States should be subject to additional conditions, such as a minimum foreign trading volume or listing on a major foreign exchange for them to receive accommodations that are not available to U.S. companies. Now, to be clear, the SEC welcomes foreign companies that seek access to the United States capital markets. This concept release is not a signal that the SEC intends to disincentivize these firms from listing on U.S. exchanges. Rather, our goal is to better understand the impact on U.S. investors and on the U.S. market resulting from significant changes to the population of foreign companies that are listed in the United States that have developed over the last 2 decades. So among the notable changes are the demographics of foreign companies reporting to the SEC and the trend of incorporating in a jurisdiction such as the Cayman Islands that differs from where the company is headquartered, operates its business, and is subject to a governance framework that implicates shareholder interests. In light of these changes, does the SEC's original rationale for extending special accommodations to all foreign companies without qualification still make sense, or should our rules be updated? Retrospective review of our rules to evaluate whether they continue to achieve their intended policy goals is one of the hallmarks, I think, of an effective regulatory agenda. So while the official comment period closed this past Monday, the SEC, of course, will consider input that after the due date in evaluating whether to propose rule changes, and I look forward to receiving this public feedback on this topic. So as we look at with fresh eyes at the types of foreign issuers that receive special accommodations, We should also not lose sight of the bedrock beneath any effective regulatory regime, and that is high-quality accounting standards and financial materiality. So with respect to accounting standards, U.S. companies must prepare their financial statements in accordance with U.S. GAAP, or generally accepted accounting principles in the United States. During my previous tenure as SEC as a commissioner from 2002 to 2008, in 2007, I voted to support rule changes to permit foreign companies to present financial statements prepared in accordance with the International Financial Reporting Standards as issued by the International Accounting Standards Board without reconciliation to U.S. GAAP. When the SEC eliminated the reconciliation requirement, it noted that, quote, the IASB's sustainability, governance, and continued operation in a standalone manner as a standard setter are significant considerations in eliminating the reconciliation requirement, as those factors relate to the ability of the IASB to continue to develop high-quality, globally accepted standards, unquote. The SEC specifically noted the ability of the IASC Foundation, which was the predecessor to the current IFRS Foundation, to obtain stable funding for the IASB. Then in 2021, the IRS Foundation announced the formation of the so-called International Sustainability Standards Board, and its trustees are now responsible for securing funding for both the IASB and for the ISSB. This recent expansion of the IFRS's foundation's remit must not divert its focus from its long-standing core responsibility of funding the IASB. In turn, the IASB must promote high-quality accounting standards that are focused solely on driving reliable financial reporting and are not used as some backdoor to achieve political or social agendas. Reliable financial reporting is critical to supporting capital allocation decisions. We all have a strong interest in the IASBs being fully funded and operational, and I encourage the IFRS Foundation to meet its goal for stable funding that prioritizes the IASB and its focus on standards for financial accounting rather than specious and speculative issues. If the IASB does not receive full, stable funding, then one of the underlying premises for that 2007 elimination by the SEC of the reconciliation requirement for foreign companies may no longer be valid, and we may need to engage in a retrospective review of that decision. So, of course, in addition to high-quality accounting standards, regulation based on financial materiality is another pillar of maximizing the efficient flow of capital. A focus on financial materiality means that disclosure requirements, corporate governance standards, and other regulations are aimed at interests of investors who, after all, provide capital to power the products, services, and jobs created by the corporation. In contrast, a regulatory regime based on other concepts such as double materiality considers other non-financial factors. In the European Union, two recently passed laws, the Corporate Sustainability Reporting Directive and the Corporate Sustainability Due Diligence Directive, promote a double materiality regulatory approach. These laws also impact U.S. companies with operations in the European Union. So I have significant concerns with the prescriptive nature of these laws and their burdens on American companies, the costs of which are potentially passed on to American investors and to American customers. While I'm encouraged by the European Union's recent commitment to ensure that these laws do not pose undue restrictions on transatlantic trade, as well as efforts to streamline and simplify these laws, further work remains to refocus regulatory regimes on the sound principles behind financial materiality instead of the more imprecise double materiality principle. Indeed, as Europe seeks to promote its capital markets by attracting more companies and investment, it should focus on reducing unnecessary reporting burdens on issuers rather than pursuing ends that are unrelated to economic success of companies and to the well-being of their shareholders. So turning to another point, as we call on our partners to foster investor confidence and dynamic markets in their jurisdictions, these same priorities compel us in the United States to unleash the potential of digital assets in ours. As I referenced earlier today, in the late 1980s, I worked about 4 kilometers away from here on the Place La Concorde. At the time, I could hardly have imagined returning in my current role to speak of new technologies, including those that once were dismissed or resisted outright, yet are now revolutionizing global finance. It seems only fitting, here just steps away from the Avenue Victor Hugo, to summon his words to our moment. On résiste à l'invasion des armées, on ne résiste pas à l'invasion des idées. An invasion of armies can be resisted, but not an idea whose time has come. And today, ladies and gentlemen, we must admit that crypto's time has come. For too long, the SEC has weaponized its investigatory, subpoena, and enforcement authorities to subvert the crypto industry. That approach was not only ineffective, but injurious. It drove jobs, innovation, and capital overseas. American entrepreneurs bore the brunt and have been forced to spend fortunes on building a legal defense instead of a business. That chapter belongs to history. It's a new day at the SEC. Policy is no longer set by ad hoc enforcement actions. We will provide clear, predictable rules of the road so that innovators can thrive in the United States. President Trump has tasked me and my counterparts across the administration with making America the crypto capital of the world. And the President's Working Group on Digital Asset Markets has delivered a bold blueprint to guide us in those efforts. As Congress drafts comprehensive legislation, the President's Working Group has directed U.S. regulators to move swiftly towards modernizing our outdated rulebooks. At the agency, we are delivering on this mandate through Project Crypto, which is a sweeping initiative to modernize securities rules and regulations to enable our markets to move on-chain. Our priorities are clear. We must provide certainty regarding the security status of crypto assets. Most crypto tokens are not securities, and we will draw the lines clearly. We must ensure that entrepreneurs can raise capital on-chain without endless legal uncertainty. And we must allow for what I like to call a super app trading platform innovation that increases choices for market participants. Platforms should be able to offer trading, lending, and staking under a single regulatory umbrella. Investors, advisors, and broker-dealers should have the freedom to choose multiple custody solutions as well. So meanwhile, in keeping with the recent President's Working Group report, the SEC will work with other agencies so that a platform can offer trading in crypto assets, whether or not they are securities, along with services like staking and lending under a single regulatory umbrella. I believe regulators should provide the minimum effective dose of regulation needed to protect investors and no more. We should not overburden entrepreneurs with duplicative rules that only the largest incumbents can bear. By unleashing venue and product competition, we can actually help ensure that American companies compete globally on a level playing field. President Trump calls America a nation of builders. Under my chairmanship, the SEC will encourage those builders, not suffocate them under a pile of red tape. Our goal is simple: to spark a golden age of financial innovation on U.S. soil. Whether through tokenized stock ledgers or entirely new asset classes, we want breakthroughs to be made in America's markets under American oversight for the benefit of American investors. So, of course, those priorities can reach their fullest potential when we work strategically with our international partners who share our commitment to innovation and to regulatory clarity. Markets prosper when capital flows freely to its most productive uses, and public blockchains, which are inherently global, offer a rare chance to modernize the foundations of the payments and capital markets. By working together, the United States and Europe can strengthen our domestic economies while reinforcing our transatlantic partnership. Europe, much to its credit, has moved early. As the Digital Asset Markets Report recognized, the EU's Markets in Crypto Assets regulation exemplifies a comprehensive digital assets regime. Some European policymakers have already called for a MiCA 2 to address decentralized finance, non-fungible tokens, and digital asset lending. I applaud our European allies for their foresight in this initial attempt at regulatory clarity, and I think it is paramount for the United States to learn from these efforts. That said, I'm determined to ensure that America is second to none in fostering an economic climate that supports financial innovation. As we catch up, I look forward to collaborating with our international counterparts to facilitate more innovative markets. Working together, as Alexandre de Tocqueville might have put it, we can extend the sphere of freedom and prosperity. For our part, America's financial leadership depends on charting the future rather than fearing it. Just as blockchain is reshaping how we trade and settle assets, artificial intelligence is opening the door to agentic finance, a system whereby autonomous AI agents execute trades, allocate capital, and manage risks at speeds that no human can match, with securities law compliance embedded right there in the code. The benefits could be immense: faster markets, lower costs, and broader access to strategies that were once reserved only for Wall Street's largest firms. By coupling AI with blockchains, we could empower individuals, strengthen competition, and unlock new prosperity. The government's responsibility here is to ensure that common sense guardrails are in place while eliminating the regulatory obstructions that stifle innovation. AI is now part of our capital markets, and its role will only grow. We must resist the temptation to overreact out of fear. On-chain capital markets and agentic finance are on the horizon, and the world is watching. The choice before us is simple yet profound. Either America steps forward with confidence and conviction, or others will. And so I choose leadership, freedom, and growth for our markets, for our economy, and for the next generation. And I'm eager to work with my international counterparts who are interested in joining us in this pursuit for a more prosperous and a free society. So in closing, with your partnership, we can shape future regulatory initiatives so that they fulfill their intended function of protecting investors while preserving plentiful room for innovators and entrepreneurs to thrive. As I mentioned earlier, it is a new day at the SEC as we realign the agency's enduring principles with emergent possibilities. I'm confident that international cooperation in regulatory matters that I've discussed here today will benefit all of us in the long run, across the United States and around the globe. And I look forward to engaging in this work together with the resolve worthy of the opportunities before us. So for now, I want to thank you for your time and attention. You've been a patient and indulgent audience, and you have my best wishes for a wonderful remainder of your roundtable. And alors, merci mesdames et messieurs de votre attention, et je vous souhaite un bon après-midi. Merci.